How would mortgages work? Very differently. Builders would issue their own credit. They would not borrow money from a bank. Therefore, there would be no payment schedule and no interest clock to beat in order for the builder to make a profit. Timely delivery of desirable product would be the only commitment the builder would have to meet. Buyers wouldn't borrow from a bank either. Instead, buyers would enter into a partnership agreement with the builder and buy out the builder's share over time. As long as the payments were kept up, the builder would be a silent partner. Subsequent buyers would do likewise. Everyone would be free to negotiate their own pay-as-we-go arrangements, free of any conditions imposed by a bank. Bank-like services could still exist to facilitate these processes, but the pretense of lending money would end. In this mortgage partnership system, no one would lose their equity in any partnership until what they paid in is paid back out to them. Forfeiting collateral would be a thing of the past. In addition, payments in this system would have what economists call a counter-cyclical effect. Here's how it would work. In a growth cycle with a boom in housing, the issuer could gradually increase its credit issue to pay more people to build more houses because it would have a gradually increasing revenue stream from new sales. On a downturn, the builder must reduce production to meet reduced demand. This means a reduction in new credit issue. But incoming long-term payments remain the same, creating an imbalance that will eventually overvalue the issuer-builder's credit. Therefore, the issuer-builder must still spend as much as it takes in to maintain its credit at par. To accomplish this, the issuer could pay laid-off workers, reduce buyer payments if requested, invest in a new job-creating industry, give to charities, or spend it all foolishly. The point is that by whatever means, the same amount of credit must be spent as is coming in. This amount would only very slowly taper off as some of the payments finished. This would make long-term debts like mortgages natural bridges over economic downturns. This would be the opposite to what happens in the current system. In the current bank credit system, the principal is removed from circulation once it's paid to the bank. This money requires a new loan to replace it. If no one's willing to take this loan, the money supply is reduced. If every dollar has been lent multiple times, as in our current situation, the lack of $1 in new loans results in an unavoidable shortage of principal with which to pay off multiple loans. In contrast, the self-issued credit must be immediately returned to circulation, interest-free, as spending. A decline in the real estate market would still mean fewer jobs building houses, but the possibility of widespread foreclosures and homeless people camping outside of their vandalized homes would be gone. To the house buyer and citizen, the proposed new system offers the following benefits. No one is doomed by the calendar and by the dictates of a bank formula. No one ever loses their equity in any property they've paid for. And no one needs to fear that widespread defaults will result in a deflationary death spiral or ridiculous bailouts, because in this new self-issued credit system, long-term mortgage payments will provide a natural bridge over economic downturns.